All right, so we got our template. I won't test you tonight, but I may next Tuesday night. But someone asks you in an interview, how do you distinguish between a good company and a good stock? Where do you start? Somebody off the top of your head? Industry analysis, such as what? Good. I can never spell analysis. Bill Gates can. All right. What else do you do? Screening model. And how do you use that in interview? Proprietary quantitative ranking screening model. Something. You want to get the word proprietary in there and quantitative in there. Especially if it's HR. You say that to HR and they think you're a genius. So proprietary quantitative ranking model, proprietary quantitative screening model. So you're trying to get down to, what are you trying to get to?
Buy list.
Your buy list. So then they ask, why don't you just buy your buy list? You say, well, my screening model is identifying some good candidates, but I really need to do some detailed analysis. How would you do the detailed analysis?
Liquidity, solvency.
Well, that's financial analysis. So company analysis. So you say, you know what? I'll start with the industry. Porter's analysis. Is this a good industry? Buyer power, supplier power. What's going on in this industry? Is it an industry that's growing? You know, I might actually here also talk about life cycle. That might not be a bad approach. Then once I understand the industry, I'm then going to do a screening model. Your screening model is going to be real similar to your financial analysis. What are you doing before the financial analysis? What were those two things we talked about? What are two things that you could do? Value chain analysis and SWOT analysis. And as I say with the SWOT analysis, the OT frequently has a lot of overlaps with Porter's. The opportunities and threats you're seeing in Porter's are often the opportunities and threats for the company side. What things can you do there? And you may want to talk about them. You know, I'm going to read the annual report about the business. I'm going to look for the CEO speaking maybe on YouTube or at conferences. I'm going to do value chain analysis. I might do one using AI, try to get AI into your discussion. I might use IBIS World. SWOT out, you know, those kind of things. What are you looking for? He's looking for what separates this firm from others. Do they have what? Do they have an economic moat? What's another way of saying that? A competitive, sustainable advantage. Those are the kind of terms you want to use, and you want to know what they mean. So have some sense of that. One of the worst things for me, I remember when we did the sector wars, I can tell when a student gets a question they don't know the answer to, and they suddenly start throwing out every single piece of jargon they've ever heard in undergraduate and putting them randomly together into a sentence. Oh, it's so painful. So, you know, don't bring something up if you don't know the answer to it. So what is competitive sustainable advantage? We talked about that. They should have above WACC return on invested capital, or they should have positive EVAs. That's the way you can say it. A firm that has a competitive, sustainable competitive advantage, they're making a return on capital greater than their cost of capital. They have a positive EVA. So there's ways you can bring this into the interview and use terms. Hopefully you're comfortable with them. Use terms that are powerful. Now, one thing you can, I forgot to mention this, one thing you can do in Bloomberg is bring up your company and just type WACC. And Bloomberg brings up the EVA for your firm. And you'll see the chart it brings up is a pretty good chart. Obviously, you're stuck with Bloomberg's definition of WACC and Bloomberg's definition of return on invested capital. But I mean, it's a definition that's consistent over time. So yeah, you try to whack, you might even bring this into your pitch book. Their analysis that this is a firm whose EVA is expanding over time. You might even graph to EVA over time. Financial analysis. All right. So Carson, how would you break that up?
Liquidity. Or short-term
Yeah,
solvency.
short-term viability. Solvency. Did you say solvency?
Yeah,
Okay.
and then for our long-term growth. Start by looking at the turnover. And then our margins. Or no, put ROE down there somewhere.
And here I like to do quality earnings
All right.
and ratings as my summary. Quality earnings, we saw that with the firm I can never remember the name of, but that the firms that went out of business this last week. You know, were there some hints in advance at Tricolor and the other brands? What is it, brands? First Brands? Was there any, because when firms are in trouble, you should start noticing things in their financials that are clues. The credit ratings are pretty good. Someone was asking what if my firm doesn't have credit ratings, so I do think the Bloomberg probability of default is a pretty decent number to give you some insights. And I don't know if y'all notice, if you go on the Bloomberg and look at that default probability, there's a whole page with a lot of information. They say this particular default rating makes them investment grade or makes them high yield. They'll actually give you the category that they're in. They won't say if it's AAA or AA or single A, but I say if it's investment grade or high yield, and they will break the investment grade into different categories. So ROE decomposition. All right, what else do you do besides financial analysis? What's the Excel spreadsheet we've been working on? DCF valuation. What else might you do?
Comparative.
Relative valuation or relative value analysis. That's what we're going to do tonight. What else might you do?
Investment bank.
Yeah, an investment bank, which essentially is DCF plus relative. Combination of the two. And you might summarize that how?
Football.
Yeah, football chart. And then what's the last thing you do? Recommendation. Buy, sell, hold. Now our CFA team, Reed's team got it. No, was it Reed's team? Can't remember. Yeah, it might have been yours. So someone was saying that sell meant short. Was that your team that got that? Would you really short the security? And to me, sell doesn't mean short. So buy means if you don't own it, buy it. If you do own it, keep it. Sell means if you own it, sell it. To me, I would say buy more, sell hold would be next. So buy more, or like enough to hold it, but don't buy more, sell, and then my last order would be short. So I would have short in a different category than sell. Sell is if you own it. Yeah, Reed, sorry.
Oh, yeah, I think the question that came up for us was, if you have a hold recommendation for AZZ, then why wouldn't you hold just a treasury for X amount of time?
Oh, yeah, I remember they asked that question, and one of the students, I think that was to another team, wasn't it? Yeah. And one student had the answer, but that team didn't have the answer. You're saying hold, why don't you buy treasury? Well, because it's gonna make 7%, treasury can make 4%, that 3% covers you for the risks. So yeah, I mean, it's a good investment. Why not? So yeah, one student had the answer for that. Yeah, they do ask kind of questions like this, but yeah, your team got something like this, Reed. I don't remember the exact question. So I don't consider sell and short the same. What is short? You're selling it when you don't own it. That to me is a much more aggressive play. So if you own it, sell it. Hold, to me, hold is hold. unless there is something better. So, if you got a buy on a stock that you don't own yet, then yeah, if you have something that's hold, sell the hold. I mean, there's different categories in here, but some recommendation, you don't have to be quite that precise. You can do buy, hold, sell. There's other things you can do, certainly. This is just a high level, but I'm trying to give you a good answer in an interview where, I've asked this question so many times, and I don't think I've gotten more than 2 good answers from college graduates. I've gotten from people, recent college graduates. I've gotten great answers from people in the business for 10 years. In fact, they can go on for hours. So get so that you can do this top of your head. I might catch you in the hallway one time and ask you that question and see if we're standing there more than 3 minutes. All right. Let's finish up the DCF model. So on the DCF model, we did the valuation. What we didn't talk about was the H model. So what the H model does, so DCF, the Gordon growth, it takes some measure of cash flow times 1 plus the growth divided by your discount rate minus your growth. You only have one growth rate. And so if you have a firm that's growing unusually fast right now, but is eventually going to grow at a different rate, you need to expand that. And that's what the H model does. The H model takes the Gordon growth model, but it gives you a hyper growth period. So it takes the cash flow plus times 1 plus G plus that cash flow times H times growth short term minus growth long term, and divides that by KE minus growth long term. And essentially you're bringing in this hyper growth period. The H is called, I call it the half-life. What you're looking at is how long does it take to get, if you start at a high growth rate, but you're ultimately going to get to a long-term growth rate, how many years is that? Your H is that number of years times 0.5. It's half of that period. So if you're starting at 20% growth, but you're ultimately going to be 5% growth, and that's going to take your 10 years, then your H is going to be 5. All right. I don't know who developed this model. I showed it to my EMBA students, and I had some engineers say, oh yeah, we use that function all the time. So, okay, fine. I don't know. I guess there's an engineering, I don't know, Rajan, if you know an engineering function for that. Very simple, right? What I don't use, and I don't know if anyone else uses the multi-stage growth models. I don't use those anymore. Why? Because we have Excel now. Do multi-stage, you might as well just forecast the years independently and just value the company independently, because those formulas are just a little bit much. So I like the H model. Where did I find the H model? It was in the footnotes in a CFA reading. I thought it was pretty cool, so I started using it. I don't know if other professors use it, but I think it's a pretty cool model. What is the G long term? It's also known as the terminal growth. It's kind of the growth that they ultimately get to. So for the H model, you need 2 extra things. You need this H, and you need a growth short term. Now, technically, if you only have one growth rate in the Gordon growth, you might use a higher growth rate there to try to incorporate the short-term higher growth rate to the longer-term growth rate. If you use the same G in the discounted growth in the DCF model that you use for growth long-term, then obviously the H model is going to give you a much higher valuation if your growth short-term is higher. But those are the models. So you might see the DCF, if you're using your terminal growth rate in DCF for a firm that's growing faster now, you're kind of valuing the firm as is without any innovation and CapEx, any kind of growth opportunity. So it's going to give you a much lower valuation. So you'll have to decide how to come up with these long-term and short-term. Long-term growth rate, to me, I tie that to the US economy or population growth plus inflation, something like that. It's not going to be, you're not going to have the economy growing at 5% and the terminal growth rate being 15%. It's just not going to happen. No firm's going to grow that radically fast. So something that's tied, oh man, getting kinds of, someone WhatsApping me right now in this class. All right, have y'all tried that with professors? Start sending a bunch of WhatsApp in the middle of class, trying to distract them, is that, so I don't know who that's from. I must get 3 WhatsApps a month, so I don't know what that's coming from. All right. So there's your long-term growth rate really needs to be really similar for most companies. You're not going to use 8% for Microsoft and 3% for Apple. They're all going to be really very similar and very much tied to the economy. Your short-term growth, that's where we have the 3 approaches above. We talked about the PEG ratio, the sustainable growth, and the you look at history, recent history, and you look at Bloomberg, Analyst. Those are all looking out the next 3, 4, 5 years kind of thing. So these approaches I showed up above, these are really getting you to the short-term growth. What is the market, like here, the PEG ratio is really, what does the market think the growth is going to be over the next 5 years? Bloomberg, what does Bloomberg think the growth is going to be? So Nicholas and I, we kind of did some circular logic. His firm didn't have a PEG ratio and said, well, we can use Bloomberg. We can back into the PEG ratio. We got, oh yeah, that gives us, Bloomberg's thinking 11% growth. We'll do that to get the PEG ratio, and then the implied growth was 11%. We go, oh, well, we get the same answer. Right, we're kind of circling into it. So if your firm doesn't have a PEG ratio or a PEG-E ratio, you're kind of going to be stuck with using Bloomberg, which is essentially the same thing, right? You're looking for what does the market think? What do investors think the growth of this firm is going to be? And you can get that by using the EE function in Bloomberg and just getting the growth rates off of there. I do both revenue and EPS, even though you're really after EPS. You can do dividends as well if your firm pays dividends. So that's really more the short-term side. The long-term, you probably could use the same long-term growth rate for most of your firms. I've had some argue that, wow, this firm's just so innovative that they're always going to be a little bit higher growth than anybody else, even long-term. I don't know. Those kind of arguments, right? And then the H. Where do you get the H? I have no earthly idea. So this is really where you're thinking about the life cycle of the firm. Where are they in the life cycle? What is a typical life cycle last in energy industry like this? It's really tough for NVIDIA. What is the, y'all have heard of the S-curve, right? A new technology. You're trying to find that sharp up and then it's going to kind of flatten out. What is that S-curve for AI? What is it for NVIDIA? It's tough. So try to find one thing I will say on the H is high growth, super high growth, greater than 10 years is unusual. It just, you don't see these 20, 30% growth rates lasting that long of a period. 10 is really tough. I know you're going to say, well, what about Microsoft? What about NVIDIA? What about, yeah, we're talking about 10 firms out of 80,000 firms. Yeah, there are a few that have these ridiculous growth rates, but it's not going to be it's not going to be that many firms that can sustain. And why is that? Well, it attracts a lot of competition, first of all. Secondly, once you become a $4 trillion company, it's really tough for a $4 trillion company to grow 50%. And you know, it's just tough. You get so big. Apple's a good example. You know, this week Apple did really well, right? With really old technology, iPhones, kind of old school. The market's still waiting for Apple to do some AI stuff, but some old school. But still, for Apple to create a whole new product that's going to take off, it's going to start out at 0.1% of their business. And it's going to have to grow really fast to have an impact on the rest of their business. So it's just tough for big firms to grow that fast. All right, so you plug all that in. The blue numbers are the things you have to input. So you have this page there's not that much for you to input. There's 9 numbers there. That's it. You have 9 numbers to input. How much easier it can get than that? So you need 9 numbers here. And then on the discount rate, you have your beta discussion that's going to be, you know, a little bit more detailed, but essentially very similar numbers all throughout. What beta would you use for McDonald's?
A more defensive beta.
Do you think it's a defensive company? Or $15-$20 meals? Is it less defensive now that it charges $20? They're trying to bring back in the dollar menu kind of thing, right? They're trying to bring in the cheap meal again.
Charges 20.
And the last time I went to McDonald's for a cheap meal, it was like $15-$20. Yeah,
That's crazy.
I was shocked.
McDonald's.
Yeah, it's,
There's your building.
I ate at Ming's yesterday and it was like $11. So that was really cheap. They had some stuff for $5. So it's like, ask the waiter, is there like something wrong with this? It's only $5. You know, well, it's not a whole lot of food, like $5. So anyway, but yeah, McDonald's, I kind of think of McDonald's as kind of close to 1, but slightly below 1, but I don't give it a 0.6, 0.7. But I look at the history and see what's going on. But you know, some firms are kind of in that one area, but be ready to defend it. Why you think that's the case? All right, any questions on this file? I saw that Joshua, you're working on this weekend.
Mhm.
So we're going to get into, I was talking to Reed's team this afternoon. I want him to find one stock for you to pass on to your mentee. And maybe Josh will help them with some of that. Maybe Josh could do one of his stocks and show them this file. I'll help them. And if you want to help them, if you want to be a mentor and work with them, you can certainly do that as well. You might have 3 stocks that you want to work on, but you have one that's kind of on the wings. You're like, man, I might do that one, but I'm not really sure. Maybe I'll throw that over to this mentee and let them work on it and pull in the numbers, put it together and send it to you. So I'm hoping each one of y'all will send me one stock to work on and then let me know if you want to work with your mentee or you want me and Joshua to work with them. So essentially Joshua's going to train people to do this class before they even take it. So we'll have some superstars, just like we already have some superstars in here. So questions on this? Has anyone gone through this whole model yet for a company? Right, so let me know if there's any problems with it. We were having some Bloomberg issues today, but we're not really sure why the Bloomberg tab keeps disappearing from Excel. If it disappears, get out, run API diagnostics, get back in. If it doesn't show up, Nicholas got out again, got back in, and it showed up the 3rd time.
Was that not all the recruiters have capital IT plugin either?
Yeah, and those we don't know how to add back in. Then you just switch machines and just hope for the best. Yeah, it's what I've discovered is machines that have both Bloomberg and Capital IQ are really struggling. So you might do your Capital IQ on a machine that doesn't have Bloomberg on it, and it might work better. The teacher station seems to be working really, really well. So you can use a teacher station, so feel free to try that out. Just don't give it in a limit so that I can't use it, or I try not to pull so much data that I can't use it. All right, so this is a decent spreadsheet. If you want to build your own, you're perfectly allowed to do that, but I'm trying to get you so you can pull most of that obvious stuff in automatically from Bloomberg, and Bloomberg does a pretty good job. Plus, it's proprietary, it's quantitative valuation. So that's the other thing you're going to add, right? Here you have a proprietary quantitative screening model. And here you're going to have proprietary so just keep those things all together, or do a thesaurus on these words and fancy it up even more. All right, let's talk relative value. So some of y'all have seen this presentation before. I'm going to skip the real estate piece of it. I want to get down to the meat of it. If you haven't seen this before, it's out there. I showed a little bit of this in these investment society meeting. So relative value is absolutely pervasive in finance. I think I mentioned some of y'all, Demoterin. He used to not teach relative value at all in his classes. And you tell us students, this kind of cash flow is the way to go. That's what everybody does. And the students said, absolutely. But then he was kind of curious. So he asked people 5 years after graduation and discovered that 100% of them were using relative value analysis and almost none of them were doing discounted cash flows, which I found hard to believe because we use discounted cash flows at USAA. He did find most of them did that investment banking model. I think when we see that that's really more relative value analysis than it is this kind of cash flow analysis. So it's very, very prominent. So what the Motorin decided to do is start teaching relative value analysis, but at least let's teach it correctly. So where does this fit in? So for both asset strategy, deciding if you're going to be large cap, small cap, value growth, US, non-US, you can use these three techniques. And for security analysis, which is what we're doing, picking a security, you can use these three approaches. So fundamental analysis, that to me is your ratio analysis and your discounted cash flow analysis. That's fundamental analysis. You're doing ratios to look at growth, trying to figure out the growth, make sure the firm's viable, that they're in good shape. And then fundamental analysis, you're going to use that to come up with growth rates, do a discounted cash flow model, come up with an intrinsic value and decide whether this stock is worthwhile to buy or not. Technical analysis we don't use in this class, but you can if you'd like to. We do have a scholarship now for the CMT. I think Robert's looking into that. I just got an email from the CMT I can send over to you. So they have a scholarship, you can take it. I'm not sure. I emailed a student that took it, but I must not have his right email. I need to find him somewhere. I want to connect him with Robert so you can kind of see what that student's doing now. Bloomberg has an excellent technical analysis kind of whole series. So just type the word TECH on Bloomberg and bring it up, and you can, there's thousands of them. It's kind of shocking. So we're not going to do that in this class. I did do this in this class last year. I had one paper that I did it on. It was like the easiest paper of the whole thing, but we're not going to do that. We use technical analysis at USAA really to decide if this is a good point to get in. So just, especially if a stock looks overbought, like what was overbought yesterday that finally corrected?
Allen too.
No.
Good.
Gold. Yeah. What did gold do yesterday? Oh, there it is right there.
Oh, wow.
That's a pretty big drop, isn't it? I don't know what percentage that is.
What happened?
300.
Say.
Well, the dollar strengthened, so that gold doesn't like that.
Probably nothing.
China, US might resolve their differences. The US stock market was up and then it ended up flat for the day. But who knows? There's all kinds of articles. We'll talk about it on Monday in our dashboard team. We'll definitely have to put it into our paper. But it's still about $4,000, so it's not like it's having a horrible year. It's still having a pretty decent year. But that really stands out though, doesn't it? That's a pretty big drop. It dropped pretty far back here, but not all in one day. The article's saying that's their biggest drop in a very, very long time. So pretty significant drop.
Did anything strengthen? Like did the dollar strengthen?
The dollar was up. I can't show you the dollar in here.
Yeah.
And crypto did well. So we got this thing of crypto being liquid gold, and yet the last few days gold and crypto have just been going opposite directions. So I can't show you currencies very well. This is old information because they're so constant. So I can't really say. I guess we could look at the euro. So yeah, the dollar strengthened a little bit, but yeah. All right. So that's the technical side. We won't be doing technicals, although I might do some when you give me a stock to buy where I'll look. So overbought, what ratio would you use for overbought? What's that called? Anybody know? RSI, yes. RSI is a pretty easy one to look at and just say, well, this stock, man, it just shot up. So RSI is kind of looking at a band, and if a stock kind of with standard deviation, if stock just shoots above that, so they move like 3 standard deviations or something really fast, you say, wow, they're really, really overbought. You might want to wait that stock to purchase it. Or if it's oversold, you might say, well, it's a good time to buy it. It's just really, it's overcorrected too much. But we're going to talk about relative value analysis. I could show you the real estate example, but we'll skip that. But relative value analysis, you're going to take some market value of the security and compare it to a fundamental factor using an accounting factor. Doesn't have to be an accounting factor. You can use other things besides accounting factors. We may talk about some of those that you could probably use. So here's your choices for the value that we're going to use. Price and enterprise value. So price is what the stockholders have. Enterprise value is the stockholders plus the bond value. Sometimes the stockholders plus the bond value minus cash. So it is possible enterprise value can be less than the stock value. If a firm has more cash than it has in debt, enterprise value can actually be smaller. All right. So those are the two valuations that we use. The fundamental factor can be anything. But we usually use earnings, revenue, and book value. Those are the three we typically use. So then you have to just know when to use price, when to use enterprise value. But there are industry-specific ones. For auto industry, sometimes I'll use enterprise value to number of cars sold, just out of curiosity. Sometimes, like with Meta, I like to use enterprise value to number of employees, just because Meta was this massive firm with very few employees. You know, Meta is like what? Oh man, 100 times the size of USA, maybe, or 50 times the size of USA with fewer employees than USA. So their market value is several times USA's, but they have fewer employees. I mean, that's pretty impressive, right? How do you have that much value? You don't have that many employees. So there's other things you can bring in that are interesting. They may not exist on Bloomberg, but you can certainly bring the pieces in and create it yourself. So there are some industry specific ones. A good example we'll see in the spring. So utilities, the most important thing for utilities is regulatory assets. What are those assets? They get the price off the regulatory side. So they like to do enterprise value, the regulatory assets. So that's a pretty common one for them. What do you think real estate companies use? Anybody know REITs? FFO, anyone know what FFO is?
Fashion. Fund of funds.
Funds from operations. So what is that versus cash from operations? So real estate has their own FFO. If you're interviewing with a REIT, you will want to know what FFO is because that's their term. What do banks use? We'll get into that. Most common one for banks. So we'll get into that. So there's some you should just know off the top of your head. Like it's just obvious with banks. I did life insurance companies, insurance companies, and banks. I always use the same ratio. Pretty common. What about BlackRock? What would you do? Industry specific for BlackRock. What's the most important term? It just came out. I was shocked when I saw it.
AUM.
AUM. What is their AUM now? I kept thinking, when? I wonder where BlackRock's going to cross 10 trillion. And where are they now? They crossed 10 trillion. 13.5 trillion. Isn't that crazy? Right. So if you're analyzing BlackRock, what's most important for BlackRock? Well, BlackRock's pretty straightforward. It's an asset management fee times assets under management. If the stock market goes up, what happens to their assets under management? They go up. What happens to their revenue? Goes up. What kind of beta you use for BlackRock? It's pretty high beta, isn't it? When the stock market goes up, their revenues go up. I mean, it's pretty straightforward. But assets under management, I'm pretty sure, well, I don't know specifically USA, but I'm pretty sure when USA sold to Victory Capital, they looked at the price they got from Victory Capital to USA's assets under management, and they compared that to BlackRock and Fidelity and all these other firms to see T. Rowe Price, to see what kind of price they were getting. I did that as well. I thought they got underpaid, but you know, I don't know what kind of analysis they did. The people at Victory Capital, some of them think they got underpaid, but that's an industry specific ratio. So as you get into your firms, you have to see what ratio. Some industries, it's pretty straightforward. It's pretty generic. They don't use anything all that special. So relative value is not intrinsic value. So your fundamental analysis, your discounted cash flow, that's intrinsic value. This is what we think the firm is worth. Relative value doesn't ask what the firm is worth. It's asking, is your firm cheap or expensive to other firms? They may all be expensive, they may all be cheap, but your firm relative to the others is cheap or rich. And those are the terms we use, cheap and rich. I hate those terms. I would use inexpensive and expensive, but they say cheap, rich. I don't know who invented that. I'm sure there's an origin, somebody somewhere at one time, maybe from Goldman Sachs or somewhere. Maybe it was a I don't know who's the guy who wrote the I'm forgetting my famous people's names. All right, let's skip through real estate. What's the price relative we use on real estate usually?
Especially.
Price
Actually, what is
to
it? Actually, what is it, dude?
price a square foot's not a bad one, right? You're buying a house, one house is trading for $2,000 per square foot or $200 per square foot. Another one's trading for $500 per square foot. There's something going on between those two houses. One house might be on the coast of California where they have mudslides and you may not have a house in 2 months. You know, who knows? But if one's trading for 500, one's trading for 200 and it's per square foot, you're adjusting for the size of the house. So you're making that adjustment. That's what relative value is trying to do. So the key is to take your stock, adjust it for fundamentals, adjust it for risk. You've got to do both of those. We did that with our screening model, right? We had fundamentals, turnover, margins, return on capital. We had risk, debt, the EBITDA, credit ratings, those kind of things. So we adjusted it for fundamentals and risk. And then we looked at them generic to all industries is what our model did. We used price to book, EV to EBITDA, EV to sales. We didn't do many specific ones to industries, but you can now that you're down to 3 stocks, you definitely can do that now. The model I have only gives you 3 choices or 4 choices. Only gives you 4 choices. So, and really one of them you're going to have to kick out. So all 3 of those have to be in place. You have to have the appropriate price relative. You have to have some measure of fundamental value. It can be generic or industry specific, some measure of risk in your models. So essentially what you're trying to do is use this relative value and essentially forecast it based on your fundamental risk factors, which is, if you think back to our model, that's exactly what we did in our model. So we're using turnover, margin, return on capital, the Bloomberg default risk. We're using those. We weighted them all. And we said, based on that, this is where this firm's relative value should be. And then we looked at their actual relative value and we made a comparison, right? So it's kind of a forecasting. So your fundamental and risk factors are your independent variables. Your relative value is your dependent variable. You're trying to see is the firm cheap or rich versus all these other factors using relative value analysis. So let's talk about a relative value analysis. So this is something I stole from the Motorin. I think it's a good way to think about it. So does this look for value of a stock is dividends divided by KE minus G? Does that sound familiar? That's just the Gordon growth model, right? Simplified. That look familiar? This is dividend next year divided by discount rate minus long-term growth. Everybody recognizes that? That's like the most basic. I do know finance graduates that don't know this formula. I would never hire someone in finance that doesn't know this formula. That's like you got that in 3013. You got that like 6 more classes after that. So you might even gotten this in an accounting class. So make sure you know that pretty basic formula. How do we convert this into a PE ratio? Well, we can convert dividends into what? Earnings per share times the payout. Everybody agree with that? We can convert KE into what? Risk-free rate plus beta times market. What is this thing called? And who invented that?
Sharp, Professor Sweet.
William Sharp. Yeah, I'm not that sharp. We should have the sweet ratio. Wouldn't that be cool? The sweet ratio?
Make one, yeah.
We should have a sweet ratio. And then minus growth. What do we do if we divide both sides by earnings per share? Guess what? We get a PE ratio equals all of that. So what does that imply? Well, first of all, there's 2 things in here that apply to all stocks equally, the risk-free rate and the market risk premium. What does this imply the PE ratio should be when interest rates are low? If we reduce the interest rates, what do PE ratios do? Are they higher or lower? You reduce the denominator,
Lower.
it's going to be higher, right? Reduce the denominator, you divide by 4% instead of 12%, Where were PE ratios in 1980 for the US stock market? Y'all remember? You weren't alive then.
12.
Even lower, 8, 9.
Oh, wow.
Why were PE ratios so low in 1979, 1980? Interest rates were really, really high. PE ratios now are in the 25 range. Interest rates are fairly low today, but when interest rates are low, PE ratios are high. Here's a market risk premium. What do PE ratios do when market risk premiums shoot up? When people are worried about risk, they tend to fall. Now, it's a little tricky because earnings also tend to fall at that. I mean, there's a lot of things going. It's hard to have this one move and not have the others, because when the market risk premium rises, what do interest rates usually do?
Oh,
They usually fall, right? So it's hard to raise this one significantly and not affect growth, not affect risk-free rate. What happens to beta when market risk premium rises? And don't answer too quickly. If the market risk premium shoots up, what does beta do?
Nothing.
Nothing. The beta of the market is still what?
one.
Still one, right? Now, individual betas are going to go all over the place, but the market risk premium can definitely affect growth, definitely affect the risk-free rate. This is one thing when I was doing balance sheet immunization of pension plans, one of the consultants I talked to said, stocks have a long duration because when interest rates fall in this equation, stock prices go up a bunch. And I didn't talk to the guy ever again. Why? Because there's a high negative correlation, or negative correlation between risk-free rates and market risk premiums. So in 2008, the risk-free rate dropped a bunch. Did the stock market shoot up in 2008? Absolutely not. Would you wanted stocks to be covering your interest rate risk in 2008? Absolutely not. So I didn't talk to him again. I wish I could find him and have him debate me in my risk management class. But yeah, stocks are not a good long duration asset because they tend to fall when interest rates fall. But anyway, when interest rates are small or low, when everything else is equal, PE ratios tend to be high. When interest rates are high, PE ratios tend to be low. Now, the bigger correlations to inflation. When inflation is high, PE ratios are low. When inflation is low, PE ratios are high. You can run a correlation between core inflation and PE ratios. There's a fairly good relationship between those two. You can watch over time. So core inflation was really high in 79. PE ratios were really, really low. In fact, Credit Suisse, back when they existed, they used to have a formula where they said core inflation plus 18, or plus the PE, core inflation plus the PE ratio for the stock market should be lower than 22. If it's above 22, stocks are expensive. If they're low 22, stocks are cheap. But right now, the PE ratio is above 22, so the stocks are expensive even without core inflation. So I don't know if they use that ratio anymore, but they actually equated core inflation with PE ratios and combined that together. All right, so PE ratios are sensitive to the overall market. So PE ratios move with interest rates. They move with, how would you measure the market risk premium? Maybe you could look at the VIX. You could look at corporate bond spreads. There's ways you can look at that ratio. The other two are related to stocks specifically. So if a stock has a high beta, what should that do to their PE ratio? A risky stock should have what kind of PE ratio?
Low.
Low, right? A high beta stock should have a low PE ratio. So if you see a stock with a low PE ratio, you can't say it's a cheap stock, can you? What could it be?
Risky.
It could be a risky stock, a stock with a lot of debt. You got to be careful. Now, one number is subtracted. A firm with high growth should have what kind of PE ratio? A high PE ratio, right? Because you're subtracting growth. So high risk firms should have low PE ratios. High growth firms should have high PE ratios. So if a firm has a high PE ratio, like Walmart, what does that mean? Could mean low risk, could mean high growth. What does it mean for Walmart?
Low risk.
Probably low risk. Could it be high growth? What about Palantir? Is Palantir a low risk company?
Severely underpriced.
Underpriced? Maybe its beta is 0.1 and its growth is 40%. Who knows? But that's the theory. So you got to be careful, and that's why you have to, when you look at these ratios, you have to have risk and fundamentals in them. Risk is kind of captured in beta, fundamentals essentially captured in growth.
So Professor, if the ratio is kind of depending on earnings per share, and like a company, like a public company can decide how many shares they give out.
Oh, well, yeah, I mean,
Can
that's,
they manipulate their PE ratio?
no, because if you double your shares, your PE is gonna drop in half, and what is your price gonna do?
So,
If you do, no, if you have 1,000 shares and now you have 2,000 shares, what's the price of your stock gonna be?
it's diminishing.
It's gonna go from $100 to $50, right? So your PE ratio is not gonna change.
I thought he was talking about buybacks, like share repurchases.
Well, share repurchases, what that's gonna do is increase your growth rate. Because you know, you're essentially, you're buying back shares, so you're gonna have fewer shares, so each share is gonna have higher growth. But I mean, you'll notice that a good way to look at the impact of buybacks is to compare the growth in earnings per share to the growth in earnings. So you say, well, net income is growing 4%, but earnings per share is growing 5%. Why is that? Because they're buying shares back. It's causing that higher growth. Right, there's one number in this formula I didn't talk about. What number is that?
Yeah.
Payouts. Why do we ignore payouts? What's the theory there? If a firm pays out more of its earnings, what does that impact? If you pay out 100% of your earnings instead of 50%, what does that impact? Growth. What does the model say? It's a perfect offset. If you pay out more, your growth drops exactly by the same amount and doesn't change the rate. That's the theory, right? So we can ignore payouts. So we don't say, wow, firms with high payouts are going to have high PE ratios. Well, no, because the growth rate is going to be lower. So we ignore the payout piece. So essentially what you're looking at with your firm, the risk-free rate, market risk premium are the same for all firms. So that part we kind of ignore in relative value analysis. Well, you got to make sure when we're comparing two firms that we adjust for risk, we adjust for growth. Now, does beta capture all risk? It should, right? If a firm has more debt, their beta will be higher. If they have more operating leverage, their beta is going to be higher. So yeah, beta should capture risk. Does growth, can we capture that? Yeah, higher turnover, higher growth, higher margins, higher growth, better return on equity, higher growth. So yeah, all that stuff you did in fundamental analysis, that's part of that growth. So we have risk, we have growth. And you do this with other ratios. The Modron does this with price to book. He does it with EV to sales. You can expand this ratio with other ratios. You can do it with other ratios and look at it. I won't do that here, but you can do that similar type of analysis, looking at the firm. I love this approach because right there it helps you off the top of your head. You can understand PE ratios. So why are PE ratios so high right now? Interest rates are back to somewhat normal. They've been falling. Is risk higher or lower than normal? So remember, what's two fast ways to look at it? The VIX is one way. What's the other way?
Credit spreads,
What?
spreads.
Corporate rates. Yeah, I'm losing my hearing. So the VIX is at 18. What's normal for the VIX? So the VIX is what the market thinks the standard deviation of the stock market be annualized standard deviation of the stock market over the next 3 months, right? You can actually graph this, and I encourage you to try it. Graph the VIX over the 90-day vol of the S&P 500, which is the standard deviation of the annualized standard deviation of the S&P 500 the last 90 days. If you do the last 90 days standard deviation and do it to the VIX, which is the next 90 days, there's a high correlation. You almost, except for extremes, you almost can't tell them apart. They just move right together. In fact, I've done that. I've taken the VIX back as far as I can go, and then I'll substitute the 90-day. I did have the VIX back decades. The lady who built the VIX, she's a professor at Rice University. She was on our board of directors, and she was like our best board of directors person. She was so good. She was the co-developer of the VIX, and she sent me her entire file. And it was on my computer at USA. You can't take files off your computers at USA. So I should have printed out the entire thing and snuck it out of USA. I couldn't take it with me, but I should call her and just ask her for it. But oh, she was great. So I don't know how professors get on boards. Rajan, how many boards are you on? How many boards are you on? Oh, you should be on a board. You would be great. I mean, she was wonderful. We had board members. I shouldn't say this on film, but We had one board member, she was really, really smart. You could tell she just didn't have time. So she took the board books, she found one obscure page, got a question, she asked the question on that, and they looked like she really studied the whole thing. And she was off. But this professor from Rice asked the best questions. I was just having so much fun so yeah, we should nominate Rajan for our board at Victory Capital. You get paid like, I don't know, $80,000 to go to 4 meetings. It's not bad. It's kind of a nice life. Anyway, I don't know how I've got on that tangent anyway, but the VIX, you can go back further, but you can substitute the 90-day vol of the S&P for the VIX. So 18 is not that high. We jumped up just a few days ago to 25. That's kind of high. During COVID, well, during the Liberation Day, we jumped up above 40, 45 even. If you go back to COVID, you can see there's the 2008 crisis, there's COVID. So you can jump up pretty high. When you see these jumps, these won't go with the historical one. They'll just fly right by them. So we're not at a particularly high level. I buy options when the VIX falls down to 10 because options are really, really, really cheap at that point. It's been a while since we've been down to 10, but you do occasionally get down there. And you're really glad you did. If you bought options here, you would have really, really made out. So there's one, and the other one is corporate spreads. Where are corporate spreads right now?
And
So I encourage all of y'all to build this spreadsheet.
tight.
Yeah. Well, what's the other word? What's the word we use in investments? N and W.
N and W.
N,
Narrow and wide.
narrow and wide. Right? So where are spreads today?
I thought it was
Narrow.
Wait.
All right. So right now, high yield is 272 basis points. Historically, the average is 483. I don't know why anyone's buying high yield bonds right now.
What tender is this?
Huh?
What tender is
What, tender?
like tender? What tender?
Well, this is just whatever Bloomberg has. So it should be every bond in that one. You probably can break these down. I mean, there's the ticker for them. They're really long tickers. You probably can break them down by maturity if you wanted to. So how would you do that? So you just go in the Bloomberg and you just type IN. And they will give you every single benchmark they have, and you can just find the one. They bought all the benchmarks from I forgot the name of the bank, the UK bank, Barclays, and so they have all these indices. So yeah, just type IN and just click on fixed income, and you might be able to find it. I don't know, like with AAA, given that there's only 2 AAAs left, I'm not really sure what's in there, but triple B. They're 100 basis points today. Historically, they've been 174. Back in 2008, AAA had a spread of 157, which is actually higher than triple B are today by 50%. So spreads right now are pretty narrow. So you could argue right now PE ratios are high because people are just not that worried. It sounds like we're worried, right? Because with tariffs and the Fed, the shutdown, all this stuff going on, but the VIX is not unusually high. Corporate spreads are really narrow. That's why we're worried about the Brands company and the Tricolor company, First Brands and Tricolor, because we're seeing these kind of, well, what if Jamie Dimon called them? These cockroaches, when spreads are really narrow, kind of makes you a little nervous. But so right now, spreads, PE ratios are pretty high. Interest rates are low, but not ridiculously low. The 10-year treasury has spent 50% of its time above 4.5%. So 4.5 is kind of the norm, where we just fell below 4. So we're a little low, but not like we were in 2020. The VIX is kind of normal. So are growth rates unusually high? Some people say AI is really driving expected growth rates, not just for semiconductors, but for all stocks. We just saw Walmart. I don't know if y'all saw that announcement from Walmart. They're going to let you use ChatGPT to buy. Did y'all see that?
Oh, yeah.
That should be, have any of y'all tried that yet? I guess it's not available yet. That should be interesting, right? That's kind of the first firm to come out other than Duolingo to say, hey, we're going to use AI as part of our business model. So maybe there's some higher growth going on right now because of AI, who knows? But PE ratios are high, but what else could be the case? The stock market is overvalued, right? That could be the other issue. The stocks are just expensive. All right. So I pulled some numbers. I didn't put Palantir in here, but Spotify, what is Palantir trading at right now? PLTR, is that right? So their PE ratio is 585. Is that high? So Spotify, Nvidia, Costco. Why is Costco so high?
Low risk.
Low risk. Is that fully explain it? Remember, Costco's beta is a little higher than Walmart's, and Costco's trading a lot more expensively than Walmart. So if Costco is a little bit riskier than Walmart, why are they trading at such a premium to Walmart? Is Costco growing faster than Walmart? Remember, Costco has not entered the internet world. They don't do the home delivery world. That's part of their model, right? Almost by accident, that acquired video was really, really good. That Costco actually wants people to go to their stores because that's how they make more money. So interesting. Macy's is back up above 10, but they're really cheap. Why? Because of low growth or because of high risk? Probably both. So there's things going on. The Spotify overpriced. We tried Spotify for our podcast and no one listened to it, so we gave up and went back to YouTube. Do y'all use Spotify
Yes.
for music or podcasts or what?
Everything.
Does it do a good job of picking stuff for you? So it's, the good AI. All right, so if you can do a relative, you have a numerator and denominator. Numerator is going to be price or enterprise value. Price is only the stockholders. Enterprise value is stockholders and bondholders. Your denominators are going to be earnings based. We'll probably use earnings per share, EBIT and EBITDA, but we can use cash from operations. You can use free cash flow. You can use fund from operations. There are other things we can use under earnings. We can use book value, or I'll show you an alternative book value, and revenue, or there's an alternative revenue. If you're doing Valero, what would you use instead of revenue, do you think? What would be a better measure?
Yeah, what would you do instead of revenue?
Instead of revenue for
Come on, Caleb.
Barrels sold.
Mr. ONG, what would you do? Barrels refined.
What's the problem with using revenue? Gasoline prices go up, the revenues shoot up. Gasoline prices fall, but what else is moving? What happens when gasoline prices rise? What else is going up? Oil prices. What are oil prices to Valero? Are they selling oil?
Yeah.
Are they?
They're buying it.
They're buying. What is oil? That's their cost of goods sold. Gas prices go up, oil prices go up. The revenues are doing that. What's that called? You may know the difference in those two.
It started with an F.
No, it starts with a C.
The crack.
Crack spread. So if you look at them and revenue basis, they're like, oh, they look really cheap. Oh, they're really expensive, really cheap. What can we use instead? How about gross margin?
Gross profit.
What if you, instead of using revenue, use gross margin? For
Okay.
firms that have those kind of commodity driven, you might, so we don't have that this semester, right? But some of y'all might. Airlines, maybe a little bit, right? Jet fuel prices are up. They raise their prices. So for airlines, I might do revenue minus jet fuel prices. This kind of, so there are revenue related. So gross margin may be for, especially for commodity driven firms, gross margin might be a better one to use than revenue. So think through it carefully, because otherwise you're gonna find yourself getting whipsawed back and forth. Although I wouldn't use that I wouldn't even use gross margin for Valero. I'll use something else, but we'll look at it. So it's really important that your numerator and denominator are matched. If your numerator is only stockholders, your denominator has to be only stockholders. Your numerator is both stockholders and bondholders. Your denominator needs to be both. So EBIT, stockholders are stockholders and bondholders.
Stockholders.
EBIT, what does BI stand
Okay,
for?
I'm sorry.
Before interest. If it's before interest, it belongs to stockholders and bondholders. What about EBITDA?
Oh.
That's both. What about earnings per share? Stockholders, all right. Book value?
No, dude, no. Breaking both.
Book
No,
value is
it's-
assets minus liabilities.
Stockholders.
Who does that belong to? Yeah, stockholders. Revenue
Oh,
is revenue before interest expense or after? before. So you use enterprise value, price to earnings, enterprise value to EBIT, enterprise value to EBITDA, price to book value, enterprise value to revenue.
There you go.
All right, y'all see how that works? You've got to get that into your vocabulary. I remember when Jason spoke to this class, I'm still trying to get him to speak to this class. I mean, he switched very quickly. Price to earnings, EV to sales, price to earnings, price to book, EV to sales. I mean, he was EV to EBITDA. He was very precise. He did not mix those. Yahoo Finance has one error in it. They have price to revenue. They also have enterprise revenue, enterprise value to revenue, but they have price to revenue. Just ignore that one. Because if you use that price to revenue, you can have a firm that you think is cheap, but it might be a firm that just has a massive amount of debt. And so when you only use price, it looks like they're really cheap, but then you add all that debt in and suddenly they look more expensive. So you got to be careful when you mix those things up. All right, so here's your choices: earnings base, price to earnings per share, EV to EBIT, EV to EBITDA. The PEG ratio is PE ratio, so that's a perfectly fine one. Price to EV, a price or EV to free cash flow. You can do, what about cash from operations? This one's a tricky one. This is one on the CFA exam they always ask.
Yeah.
Is CFO before interest expense or after interest expense?
It's.
Let's think about where should interest expense go? Should it be operations, investing, or financing?
You know,
It should be.
It should be where? That's where it is. Where should it be? I'm asking.
it should be in finance.
Should be in finance, right? Don't you agree? Dividends are in finance, debt is in finance, buybacks are in finance, shouldn't interest expense? But it goes in the CFO. So I'll use price to CFO.
Hate that. Well.
So if you take the CFA exam, guess what one of the things they tell you to do? Move interest expense from CFO to financing.
Wait, really?
Yeah.
Very specific.
Now, how do you do that? Well, it's really tough to do because it's really hard to get interest expense from some companies because sometimes they net out interest income, sometimes they capitalize interest expense. So it gets kind of tough to do that. But price, REV, the free cash flow depends. If your free cash flow is to equity, you use price. If it's free cash flow to the firm, you use enterprise value. Book value is price to book, or I like this one. This is what the CAPE ratio is. If any of y'all have seen Robert Schiller's CAPE, I'm sorry, Bob.
Question, one of the companies I was looking at, they reported a negative interest expense.
Yeah, if you take interest expense minus interest income, you'll have that problem. In that case, yeah, you have to see if they report actual interest income and interest expense. You can do just the interest expense. Capital IQ will separate the interest expense from the interest income if you like to do it. Yeah, it could be tricky. So if you've heard of Robert Silver's CAPE ratio, essentially he's looking at price to 10 years of earnings per share, and then he's adjusting it for inflation. So y'all know the CAPE ratio. I showed it Wednesday night, the Investment Society meeting. So the CAPE ratio, he's just showing the current value of the stock market. I think I have it out there.
It just it's P ratio, but adjusted for. It's a PE ratio, but adjusted for.
I did it last. Oh no, it's not that one. All right, sorry. I have it. I mean, you can, if you want it, all you have to do is type Robert Schiller data, and it comes up. Online data, Robert Schiller, and there it is right there. You just click on it, and then you have to click again. He just keeps making it difficult for you.
What is it adjusted for?
Inflation.
I knew it. And you can't land a job, man.
So here's the CAPE ratio. Right now, he thinks stocks are really, really expensive. What I showed the Investment Society last Wednesday is I had some sense that this might look expensive because of COVID, because we had 1 year there with just artificially low earnings. So I took the COVID year out and it brought it down from 39 to 38. It only didn't affect it much. So he's essentially saying the stock market's more expensive now than it was before the Great Depression crash. Not as expensive as the .com bubble, but very, very expensive. And so that's his CAPE ratio. You can do this for individual companies. I actually like this quite a bit. So is someone doing Boeing in the capital group? In capital goods? Anybody doing Boeing? So what's the problem with Boeing is they've had negative earnings. They also don't have book value. But you can do price to like 10 years of earning per share. You can just add up 10 years of earning per share and look at that. It's somewhat of a substitute for book value that you can use now. Boeing might still be a negative number. This works, I think, really, really well for commodity firms, like doing price to 3 years or 5 years of earnings per share. I think it works well, especially if a firm is buying a lot of its stock back. It somewhat distorts that book value, where you can do price to 5 years of. I think Bloomberg actually has a price to 3 years of earnings or 5 years of earnings that you can bring in. And then revenue base, EV to sales, right? Which do you use when? Earnings base, any firms that are in high growth type of industries like technology, like consumer services, or communication services, you're almost always going to use EV to EBITDA. The Motorin says we like to say EBITDA, so we like to do EV to EBITDA. He also says he's pretty cynical, and EV to EBITDA is going to give you the lowest multiple. So a firm might have a 25 PE, but their EV to EBITDA may only be 10. And he says analysts like to go to their boss and say this firm's trading at 10. That sounds a lot cheaper than to say it's trading at 25. So he has some cynicism on why we use EV to EBITDA for technology, but that's the most common. Book value we use for high capital requirements, firms that have a high property, plant, equipment. So property, plant, equipment's 50% or more of their assets, you're probably going to use price to book. Cyclical commodity-based companies like energy and materials, you'll use price to book or price at 5 years of earnings. And then banks, insurance companies always use price to book. Very, very common approach. Or like for Victory Capital, use enterprise value, the assets under management, something along those lines. And then retail, we always use EV, the revenues. It's just the standard there. And this is the way we built our model, right? We brought in turnover, margin, return on capital, risk, and we compared it to the ratio specific to your industry. It won't make most sense. So what we'll do next class is I'm going to show you the relative value model. It has a video. It is tied to Bloomberg. I do encourage you to paste it as values. And it has a table. Not there, but somewhere. So it has at the very end, it does a valuation of your stock that you can use in your football chart. So it's a really easy model to use. It's a really good one to have. If there's a few firms you want to do this for, have your mentee do this for you. It's really easy to build. You can have them build it for you and send it over to you, and then they can give some recommendations. So I'll show you this next Tuesday in class. I might do a quiz next Tuesday on our templates. So I am going to force you to learn something this class. If I see you 2 years from now, guess what I'm going to be asking you? What is a good stock? What is a good company? So be ready for that. All right, we'll stop it there.